Holy shit, the S&P and the Nasdaq hit a new all-time high today. But Citi Bank is out with a new report in the last 10 hours that says this. The Federal Reserve might cut interest rates 8 straight times beginning in September for a total of 200 basis points by July of 2025. And get this, this is their base case forecast. So holy smokes, we need to break down this report, put this into context, and figure out exactly what Citibank is saying about our economy, about the Fed, and about markets. We also have a lot of great other information to go over what's happening in markets today, some different Wall Street opinions on what's coming next, and something I think you really need to see before we really kick off this earnings season. But let's start with this report from Citi that says the Fed could slash rates by 200 points over 8 straight meetings as the economy heads for a sharper downtrend. According to analysts at Citi Research, get ready for a bonanza of rate cuts from the Federal Reserve that starts in a few months and extends all the way into next summer. In a recent note, the bank cited fresh signs of a slowing economy for its view that the Fed will trim rates by 25 basis points 8 times starting in September and extending into July 2025. That will lower the benchmark rate by a whopping 200 basis points, or from 5.25 to 5.5% to 3.25 to 3.5%, where they will remain for the rest of 2025, the note said. The economy has cooled off from its heady pace in 2023 and inflation resuming its slowdown after some unexpected stickiness, said Citi analyst led by chief U.S. economist Andrew Hollenhorst. But the Institute for Supply Management Service Sector gauge, which abruptly reversed into negative territory, and the monthly jobs report, which showed unemployment rate rising to 4.1%, have raised the risk of a sharper weakening of economic activity and a faster pace of rate cuts, they added. The data, along with dovish comments from Fed Chair Jerome Powell on Tuesday, suggest the first rate cut will very likely come in September. It's worth mentioning that tomorrow you will get a Fed Jerome Powell testimony in front of the Senate or the House. He does this 2 days in a row. The first one's the House, I believe, maybe the Senate, and vice versa. Doesn't really matter. Markets are just going to pay attention to what Jerome Powell says, and specifically in regards to that service number via the ISM PMIs will be important. Does Fed Jerome Powell get a little bit more dovish? Does he get more willing to want to cut rates sooner? Because that was a clear indication the economy is slowing down on manufacturing and now on services. It's also worth mentioning that on Thursday we have our CPI reports that we're not really expecting much of a change here at all. Besides, your headline year-over-year number is expected to fall about 0.2% from 3.3 to 3.1%, and your month-over-month headline is expected to rise from 0% last month to 0.1%, but both your month-over-month core and your year-over-year core are expected to come in line with where you were just last month. But Jerome Powell made it very clear that most of the time, especially with regards to CPI or labor market reports, important data points, they get that information a couple days ahead. So by tomorrow, really by right now, I'm sure Fed Jerome Powell already knows what the inflation report looks like, and that could either lean him a little bit more dovish or a little bit more hawkish. So if you want to read the tea leaves with Jerome Powell tomorrow, you may get a slight indication of what that CPI number could be coming later this week. And if you don't want to read the tea leaves, I will read them for you as long as you hit that subscribe button and stay tuned to the channel for future updates. But let's continue on with this report from Citibank. They say, quote, "A continued softening of activity will provoke cuts at each of the subsequent 7 Fed meetings in our base case," Citi predicted. Now, I think this report is also fascinating because Citibank is a very large US-based bank. They're probably seeing some slowdown in consumer spending activities as well. We will get these earnings coming later in the week, Friday pre-market. You're going to get a lot of your major banks reporting earnings here based domestically. And whatever they say about people spending money can have big implications for earnings estimates this year and next year. And if Citibank is saying their base case is 8 rate cuts back to back, that's kind of insane. A base case means the most likely outcome is, let's say this, 8 rate cuts back to back starting in September. I don't know if that would be seen as a good or bad thing for the markets at this point. I guess it will all come down to what earnings estimates do for next year. You can see over the last couple of years, estimates were falling, and that's why 2022 was such a rough year. But ever since really February of 2023, about a year and a half now, EPS estimates have been consistently rising for the S&P, with a vast majority of this rise happening between December of 2023 and today. About, 8 months ago or so. That's going from, what was this? $243 per share in expected EPS to almost $260 of expected EPS. If we see consumers slowing down, the economy getting worse, or just overall earnings coming in line with expectations, there could be room for lower expectations. And I think that is a risk heading into big tech and the rest of earnings season. And this is looking at the next 12 months expected earnings for the S&P 500. So again, the economy weakens, people stop spending as much money. There could be room for these estimates to come down quite a bit. That's a potential risk. Is that a base case? No. Is that a most likely scenario? Probably not. But it is a scenario you need to be prepared for as an investor in this market. But Citibank goes on to say in their note, they point to other signs of weakness in the jobs report. While the headline payroll gain of 206,000 appears solid, prior months were revised down, and June saw a decline of 49,000 temporary service jobs, with Citi calling it the type of decline that is typically seen around recessions as employers begin reducing labor with the least strongly attached workers. Payroll data are also likely skewed to the upside, leaving the unemployment rate, which is derived from a separate survey, as the more important metric, they said. And on that front, Citi pointed to the Sahm Rule recession indicator and said it could be triggered in August if unemployment continues to rise at its current pace. Holland Hurst has been a relative contrarian this year by maintaining a dimmer view on the economy, even as the Wall Street consensus shifted to a soft landing. In May, he doubled down on his warning that the U.S. is headed for a hard landing and that Fed rate cuts wouldn't be enough to prevent it. That followed a similar forecast in February, even amid blowout jobs report. In an interview with Bloomberg TV last week, Holland Hurst noted that a sharp recession would likely produce enough political consensus for more government spending to stimulate the economy, overcoming concerns about a massive deficit, but a more mild recession may not result in such a consensus, he added. So basically, sharp slowdown, more government spending, intervention trying to pull us out of that. A just slower kind of slowdown recession probably would not prompt that kind of government intervention. He also pointed out that just as the Fed rose rates, rate hike slowed the economy less than anticipated, rate cuts have not stimulated as much. In addition, 10-year bond yields, which serve as a benchmark for a wide range of borrowing costs, are already below 2-year yields, leaving less room for further downside, especially as rising deficits and inflation add upward pressure. Last but not least, quote, most economic activity is going to be more responsive to a 5-year yield than the 10-year yield. It's not really about the overnight policy rate, Holland Hurst explained. So there really are questions about how much can you transmit the stimulative effect of lower policy rates? And he's basically saying if the Fed were to come out and start cutting rates, how much of an effect is that going to have when the government deficits are so high? And the world has kind of been revolting against U.S. Treasury markets, because the way Treasuries work is the yield is actually fixed. The price of the bond fluctuates. So investors, they don't really want to buy a bunch of U.S. bonds because of the deficits and all the debt that is being raised. And if the Fed starts to cut rates, is that going to spur more buying activity and lower yields, as a 1-to-1 ratio? Potentially not. I don't agree with that. I do think if we do go into any kind of larger slowdown, the Fed starts to, lower rates on any kind of material degree, 8 rate cuts in a row, a crazy call from Citi, then I do think Treasury yields would respond to that. I do think most importantly, investors would go out and say, hey, if we are going into a slowdown, we want to lock in these yields as a rush to safety. Put our money into bonds, because what happens is everyone kind of does that. So if you go out and buy a bond at, let's just use TLT for an example, that's trading at $92.63. As the economy gets worse, the Fed starts to cut rates. Yields on bonds will rise just like you had in 2020 and 2021. Prices will rise, yields will fall. You're going to get capital appreciation on your bonds, probably pretty sharply. And in the worst case scenario, the government is backing these bonds anyway, so you can ride out the economic storm in the bond market that still pays you over 4% and then wait to buy stocks when they come down. So I actually think bond yields would react to the Fed cutting rates or the economy just weakening faster than expected. Now, on a completely different note, you could see here the Russell 2000 is well outperforming all of your other indexes. The Dow is down 0.14%. The S&P is flat at 0%, slightly negative now. The NASDAQ is up 0.15%, but the Russell's up almost 2%, or 2%. 1%. The VIX is down about 0.5%. Seth Golden says, just in case you did not know, the Q2 2024 Russell 2000 EPS estimate leaped nearly 40% from the prior week's estimate of 13.8% to 19.5%. Nearly 40% in just the last week. That's incredible. And that is causing the Russell to, do a little bit better here as expectations get better that earnings are going to be good. Again, after today, this rotational correction looks a little more obvious, and I had people ask on the last video in the comment section, like, why would investors go out and buy other stocks besides big tech? And this is exactly it. The S&P 500's expected EPS growth rate this year is 11.3%, historically very high. 2025 is even higher at an expected 14.4% EPS growth rate. That's probably too high of an expectation. I think these numbers will come down. I think that does lead to some downside in the S&P and the NASDAQ. But the reason investors may want to consider buying some small caps instead is what? Again, you're expecting 19.5% EPS growth for Q2, the quarter that we're about to get reported on now. And then it jumps to 63.1% in Q3, and then 89.4% in Q4. In 2025, in Q1, you're at 47.8%. In Q2 of 2025, you're at 42.5%. And these are year-over-year numbers. So this would be comparing to Q2 of 2024 with EPS growth rate of 19.5%. So on a year-over-year basis, you'd be going from 19.5% to 52.5%. These are not low estimates that are just easy to beat because they're low year-over-year estimates. This is real sustainable growth, it looks like, in the Russell 2000 EPS estimates. Q3 of 2025 is expected growth of 33.4%. Q4 of 2025 is expecting 27.2% growth to EPS. And even 2026, in Q1, you're expecting 29.1% growth. This is much faster than the S&P 500. So if we are really going into the soft landing that the Fed is going to be able to engineer, which looks like a base case for investors right now, why would you not buy the Russell over the S&P? So just for anyone that was unaware, big tech is not that special in regards to EPS growth. The Russell is going to well outpace big tech, well outpace the S&P 500 as projected over the next 2 years. And that's why perhaps Tom Lee is bullish on small cap stocks. StockTwits is reposting Tom Lee's new price target for the S&P 500 by the end of this year, which is 5,800. And the direct quote from Tom Lee that says, "I think the end of the year will be a day of reckoning for those who are sitting on cash, earning 5%. Tom Lee shared this post, which was from StockTwits. And I do think that's true. By the end of this year, you're probably going to see a day of reckoning for people sitting in cash. And I think 2025 is going to be a very good broad-based bull market. I don't think it's going to be 7 stocks leading the markets higher. I actually think 2025 is going to be a great year. Probably at some point there will be some growth scare, some recession fear. Perhaps that could come by the end of this year. We just don't know, but at some point that will happen. Even if a recession does not materialize, as the unemployment rate continues to go higher, as maybe the payrolls numbers continue to get smaller, as ISMs get worse, there will be a growth scare. There will be lower EPS estimates for a period of time that will cause stocks to come down. Do not be confused on that. That will happen. The timing on that, though, is highly uncertain. There are a lot of rumors that maybe Joe Biden steps down as the Democratic nominee, and yeah, I think that could give you quite a bit of volatility alone. But let me know if you think that is going to happen down below in the comments section. Brian Dietrich writes on X, these 3 months, June, July, and August, tend to be quite strong during an election year. Then you tend to have the pre-election jitters in September and October playing out so far. Will we see selling ahead of the election? Now, what's actually interesting about this is markets are smart at this point, right? We all kind of know September, October tend to be rough during an election year. It wouldn't surprise me if they're selling ahead of September and October, just because we already know that's a weak period of time. It wouldn't surprise me if actually August is the weaker period for markets, just because, again, we know September and October are bad, right? That's very well-known information. So usually when you know something is bad or going to be bad or worse, you can see some selling ahead of that in and of itself. So I would actually expect August and September could be the worst months, again, because it's not a surprise before the election. You usually do get a sell down. And again, if everyone is expecting a sell down in September and October, that's usually not what market makers like to do. Usually the consensus view does not happen. That's like 2022. Everyone thought markets were going to get worse and this recession was going to come. At one point, Bloomberg was expecting a 100% chance of a recession. What happened, in fact, when everyone got, super bearish, markets bottomed. And then even vice versa, when people get way too bullish, which I think is roughly around where we are now, just looking at what's going on with broader markets, that's usually the time in which you see that U-turn. You are also seeing reported today by Gunjan Manjiri. She is with the Wall Street Journal that covers markets. And she's writing on X, U.S. corporate bankruptcy filings in June hit the highest level since early 2020, according to S&P Global. Jim Bianco writes on X, at least a 60-year extreme. What is the risk? That one day it's the opposite. 5 stocks are killing the index funds while everything else outperforms. Reinstated, one buys an index fund to get diversification, but with record concentration, they are not getting it. So he's basically saying that right now it's all fine and dandy that 5 stocks are leading the markets higher. But one day it could be the opposite, that 5 stocks are killing the index funds that makes the S&P and the NASDAQ look bad while everything else outperforms, which is kind of what I'm calling for at this point as well. With record low valuations, or at least recent record low valuations for the Russell, expected EPS growth that's almost 100% over the coming quarters, I think it's a pretty easy read through here that as long as we see this soft landing materialize, you're going to get a rotation out of the perceived safety of big tech into other areas like small caps. So I'm actually not bearish on the markets. I'm bearish on big tech and bullish on basically everything else. Relative to the S&P 500, the S&P 500 Momentum Index has surged to a new cycle high and is at the highest level since August of 2020. Excuse me, August of 2000. HZ on X says the peak is either here or at 5,600. Expect a significant sell-off over the next 6 months, and she's targeting around 4,000 on the SPX, which would be about 400 on the SPY by the end of this year and around the election, which would just be a crazy sell-off, and I'm not expecting this. At least not in a base case scenario. I think a simple 10 to 15% correction will do at this point. Until again, the Fed cuts rates because the economy is slowing, then you could see a larger pullback. But it's hard to say if the markets would like the Fed cutting rates or if the markets would sell off if the Fed is cutting rates and have more fears about the economy. Liz Young-Thomas, she runs the head of investment strategy at SoFi, says concentration concern. The 3-month correlation between the S&P 500 and the percent of stocks advancing has fallen below the dot-com bubble era low. And as you can see here, you have JP Morgan, Wells Fargo, Citi, and BNY Mellon as your major banks reporting earnings this Friday morning, considering Citibank's recession call. Well, not in those terms recession call, but 8 cuts, 200 basis points of easing from now until July of 2025 kind of implies some kind of recession call. We'll see what they say about the consumer. That could actually move earnings estimates quite a bit for 2025. Oppenheimer is raising their year-end target for the S&P 500 to 5,900, indicating a potential increase of nearly 6% from its current levels. This optimism is supported by a series of positive market indicators, including strong performances in various sectors and favorable economic data. However, some traders and analysts expressed caution, noting the possibility of short-term pullbacks or consolidations before further advances. The market's resilience and the anticipation of future rate cuts by the Federal Reserve contribute to the bullish sentiment, although the sustainability of these trends remains a topic of discussion among many market participants. Also worth mentioning that the first 2 weeks in July are seasonably the best 2-week period of any market of any year. The back half of July, the second half of July, tends to be a lot more negative, so this is not too uncommon to see a rally in the first half of July. I think whether or not this rally continues throughout this week comes down to Jerome Powell in large part tomorrow, because if we're going to get new information, it's probably going to be tomorrow, and then that CPI report that also comes out this week. Bob Elliott, CIO at Unlimited Funds, says this: U.S. stocks experiencing a surge in earnings expectations, not actual earnings. Investors are set up for disappointment ahead. He says 12-month forward earnings or EPS estimates have surged to $260, blend 2024 and 2025, while actual earnings have been flat, around $225 for 2 years, plus paying 21 times forward, levels only seen in the tech bubble at these bond yields. Many market commentators who are bullish on stocks will note just how strong the 12-month forward earnings are and how those have been growing in recent months, now up 12% on a year-over-year basis, in notable contrast to more timely economic data which has been flat or weakening. There are generally good reasons to focus on forward earnings rather than trailing, since in general it helps smooth out what could be one-off things in the back history, like negative earnings, and also sets the pricing baseline based on what's ahead, not what's behind. But it's important to remember that those forward expectations are not actual earnings that have been achieved. They are expectations of those earnings. In the past 12 months, forward expectations have generally aligned with economic momentum with more beta. Not today. At an index level, top-line sales growth rarely diverges from NGDP growth. Today, that's in the ballpark of 5%, just a touch below top-line estimates of 6% for 2024 and 2025. It's the margin expansion expected that is notably extreme, penciling out the highest levels ever in 2025. That is particularly divergent from the roughly stable margins that have actually been achieved, roughly 2.5% lower over the past year. At a sector level, this isn't just a high-flying tech stock story. There is much more to it. Tech is expected to have very high earnings growth, 21% and 19%, but also the lagging sectors are expected to pick up earnings considerably. And of course, it's not just in the next 12 to 24 months. Expectations are elevated. Growth expectations are in the further out years must be extremely strong given the desire to pay 21x for the 12-month forward earnings. Those levels only have been seen post-COVID and tech bubble. Paying up for these multiples at this level may feel familiar given the post-COVID valuations, but it's important to recognize that rates were totally different during that time frame. 10-year yields were negative on average, not above 2%. Very different environment. The single best indicator for the equity market over a time frame that investors care about is how growth comes in relative to expectations. Right now, whether you look at economist estimates or earnings predictions, growth expectations are very high versus recent reality. Without some sort of exogenous dynamic, it's very unlikely that the type of growth conditions currently being penciled out in the markets will come to reality. That will leave investors the choice to either hold stocks at even higher valuations or mark down expectations. He says this type of dynamic is very typical of very late cycle. Growth persists longer than most expect, and begrudgingly, growth expectations get reset higher eventually to extreme levels. That comes just as the economy starts to decelerate, as monetary policy tightness drags on economic conditions. Ultimately, the cycle turns as those high expectations aren't met in reality, and that creates a shift away from growth assets, creating negative wealth impact and slowing spending. This looks to be what is most likely to play out between now and, say, the end of 2025. Most likely, the second half of 2024 will be the start of what is likely to be an extended period of disappointment for equity holders. And you know, I gotta say, expectations are just too high, and they've been going vertical, as I showed a couple of minutes ago. So yes, this has been a great rally, but don't expect it to just continue on unless you see some very stellar earnings reports. Now, again, as the Fed starts to cut rates and as rates do go lower, depending on the economy and the speed in which that happens, then you can make an argument that maybe 21 times earnings, maybe if that number, maybe the EPS number comes in even lower, maybe the multiples even higher. Maybe it's more justified with rates being lower because there's not a, or will not be, a 4 or 5% bond market alternative. And yes, I'm actually very bullish on at least the second half of 2025, if not the entire year, but you will go through that day of reckoning at some point. But ultimately, it depends how good or bad earnings come in. And don't forget, corrections and even crashes are normal in bull markets. And I think that's exactly what this is, a bull market. So what am I doing in my portfolio? Well, I'm holding on to all of my long-term stocks. I am looking at a couple of hedges targeting around November of this year for the S&P 500 because they're the cheapest they have been in many years. At all-time highs, with the economy getting a little bit worse, with major events like the Fed and CPI coming up. I mean, why not hedge your portfolio? That's my perspective. And again, I'm not a financial advisor. I am not a financial planner. If the markets continue to go up, then my portfolio will do well. If the markets fall, my hedges will offset the losses in the portfolio, and that's fine as well. The key is, with investing, you want to set yourself up to win regardless of what happens. And especially when premiums are this cheap, it's easy to set yourself up to win no matter what happens. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Most importantly, enjoy the rest of your day, and I will see you in the next one.